Charlie and I haven't the faintest idea where the stock market is going to go next week, next month, or next year. We never talk about it. It never comes up. Our directors will tell you that they've never been to a directors meeting where the subject of the direction of the stock market is. We are not in that business. We don't know how to be in that business. Obviously, if we could guess successfully a high percentage of the time where the stock market was going to go, we would do nothing but play the S&P futures market, where there wouldn't be any reason to look at businesses and stocks. So it's just not our game. We don't think what we see when we look at the stock market is we see thousands and thousands and thousands of companies priced every day, and we ignore 99.9% of what we see, although we run our eyes over them. And then every now and then we see something that looks like it's attractively priced to us as a business. Forget about the word stock. So when we buy a stock, we would be happy with that stock if they told us the market was going to close for a couple of years. We look to the business. It's exactly the same way as if you were going to buy a farm a few miles here outside of Omaha. You would not get a price on it every day, and you wouldn't ask whether the yield was a little above expectation this year or down a little bit. You'd look at what the farm was going to produce over time. You'd look at the expected yields. You'd look at expected prices, the cost, taxes, the cost of fertilizer, and you would evaluate the intelligence of your purchase based on what the farm produced relative to your purchase price. Quotes would have nothing to do with it. That's exactly the way we look at stocks. We look at them as businesses. We make judgments about what the futures of those businesses will be, and if we're right about that in those judgments, the stocks will take care of themselves. Charlie?
Nothing to add.
He's been practicing for weeks. About the mindset of an investor, is it?
He wants you to advise him as to how he can become less like a lemming.
Well, since you repeated the question, I'm going to let you give the first answer to that, Charlie. Until he eats about 1,000 calories a day.
He wants to invest less like a lemming.
Oh, I understand that. I was giving you the first shot at it, but I will tell you what changed my own life on investing. I started investing when I was 11. I first started reading about it. I believe in reading everything in sight, and first started reading about it when I was probably 6 or 7 years old. But for about 8 years, I wandered around with technical analysis and doing all kinds of things, and then I read a book called The Intelligent Investor, and I did that when I was 19 down at the University of Nebraska. And I would say that if you absorb the lessons of The Intelligent Investor, mainly, and I wrote a foreword and I recommended particularly chapters 8 and 20, that you will not behave like a lemming, and you may do very well compared to the lemmings. We have here in the bookworm copies of The Intelligent Investor, and I think it's as great a book now as I did when I read it early, I guess, in 1950. You can't get a bad result if you follow the lessons of Ben Graham taught in that book. I should mention that there's a book out there also that I did not know it would be completed by this time. My cousin Bill Buffett has written a book about our grandfather's grocery store called Food You Will Enjoy, and Bill will be out there. He's signing books. I just got my first copy a couple of days ago, read it, and I enjoyed it a lot. Charlie worked at the same grocery store. How many years ago? Probably a good 70 years ago in Charlie's case. Neither one of us was very good. But my grandfather, you don't want to pay much attention to his advice on stocks. He wrote a lot of letters, and he was very negative on the stock market and big on hard work at the grocery store, so we quit listening to him. Instead, read The Intelligent Investor. That's the book that that gave me a philosophy that has taken me now for a lot of years. And there's 3 big lessons in there which relate to your attitude toward stocks generally, which is that you think of them as parts of a business, and your attitude toward the market, which is that you use it to serve you and not to instruct you, and then the idea of a margin of safety, of always leaving some extra room in things. But the people in this room, I think, have learned that important first lesson. I mean, I think most people that own Berkshire do not see themselves as owning something with a little ticker symbol or something that may have a favorable or unfavorable earnings surprise or something of the sort. But they rather think of themselves as owning a group of those businesses that are out there in the other room. And that's the way to look at stocks. You'll never be a lemming if you do that. Let's go to number 2.
Could you please comment on how you use stock options when trying to enter or exit a position in a public company?
Yeah, I think there was one time we sold a put on Coca-Cola with the idea that if it got exercised, we were very happy to own more Coca-Cola. It didn't get exercised. We would have been better off if we just bought the stock. Usually, if you want to buy or sell a stock, you should buy or sell the stock. And using an option technique to buy a call on a stock instead of buying the stock outright with the idea that you get it a little cheaper that way means that about 4 times out of 5 you'll be right, and the 5th time the stock will have moved earlier, and you'll have missed the transaction you wanted to have. And so we virtually have never used options as a way to enter a position or exit a position, and I would doubt very much if we do. We've sold these long-term equity put options that are described in the press release yesterday and were described in the annual report, but that's a different sort of thing. If we want to buy something, we'll just start buying it, and if we want to get out of it, we'll start selling it, and we won't get involved in any fancy techniques. Charlie?
Well, if I remember right, you wrote a letter when the public authorities were deciding whether we should have option exchanges for stocks. And Warren was all alone at that time, and he wrote a letter saying that he didn't think it would do any good at all for the country to throw out the margin rules in this fashion. I've always thought that Warren was totally right. It's the idea of turning financial markets into gambling parlors so the croupiers can make more money has never been very attractive to us.
Yeah. Yeah, it's very interesting to me when I talk to these MBA students. One of them from the University of Chicago, the very first question I got a few years ago, he says, "What are we being taught that's wrong?" I love questions like that. I have to plan them in the future. The amount of time spent at business schools, maybe it's a little less now, but teaching things like option pricing and that sort of thing, the idea that you would spend all of this time with formulas, but the problem, of course, is that the instructors know the formulas, and you don't when they come, and so they've got something to fill the time explaining to you. And it is no fun if you were teaching biblical studies, and you could read 3 or 4 of the most important religious tomes forward and backward in 5 different languages. You would hate to tell somebody that it all comes down to the 10 Commandments. I mean, any damn fool can do that. So there's a great desire of the priesthood in finance to want to teach the things that they know and you don't know, and that they spend a long time learning, and that maybe require a fair amount of mathematics. And it really has nothing to do with investment success. Investment success depends on buying into the right businesses at the right price. And you have to know how to value businesses, and you have to have an attitude that divorces you from being influenced by the market. You want the market there not to influence you. You want it there to serve you. And that requires a mindset, which goes back to an earlier question. And it's a mindset that's described quite well in Chapter 8 of The Intelligent Investor. Let's go to number 6.